Let's talk about the U.S. stock record that I just mentioned. We haven't seen huge gains this year, but we are looking at an S&P 500 that's up, Well, I guess 19%. Is that the only game in town? I mean, are you seeing more people diversifying less and focusing more on just this one asset?
Certainly what we've seen year to date is an extreme outperformance of the U.S. equity market versus pretty much every single other area in the world. That's largely due to the growth differential, which has opened up year to date, both on a macro as well as on a microeconomic level. That outperformance has been extreme, and we also think that more likely than not, it's not going to last. But clearly, in the very short term, we would think that U.S. equities will continue to move higher here, specifically also because what we're seeing is very, very strong earnings growth.
Guy?
Maximilian, when does this sort of change? Because a lot of people are out there. They've got a portfolio that has diversification within it. They've got equity diversification around the world. They've got some Japan. They've got some Europe. They've got some United States. And they're just sitting there looking at their statements, and we're about to get month-end statements again. And the U.S. is just going to outperform once again by a significant degree. How do you? Does that mean reverse at some point? What do you do with that?
It's more likely than not going to revert at some point, but what you really need for other markets, particularly emerging markets in Europe, to catch up is, on the one hand, clarity on trade, second, weakness in the US dollar, a more sustainable weakness in the US dollar, and lastly, and that's of particular importance for the European market, given its structural overweight in financials, higher interest rates in Europe.
Well, let's talk for a moment about technology, because we have a great story showing how much the market is short, the big tech names. And I've got quite a cool screen here that Hillary put together for us, which shows the number of members trading above their 200-day moving average in percentage terms. The S&P 500 here in blue, the NASDAQ in white. Why do you think the market is so short these stocks that had really been the engine for the broader rally the broader bull market, I should say, that we've seen over the past 9 years?
I think this chart illustrates very much also our thinking, because ultimately what we've done, for example, a little before that gap opened, was after 9 years of being overweight US tech, we've neutralized our position. At the time when we went overweight, we said this was secular growth at a discount. And what we found at the beginning of the year was this was still secular growth, but no longer at a discount, and actually market breadth should widen out from here. So this makes perfect sense to us and is likely going to continue. It's also very good actually for the overall market, because we had a lot of clients saying at the beginning of the year, gosh, market breadth is narrowing and this is only about tech ultimately. And what we're now starting to see is broadening out, which is good for the sustainability of this rally on an overall index level.